Good morning, everybody. We have got a fantastic turnout for this webinar, and I'm very grateful to you all for spending the time this morning to join us. Now, the recapitalisation project has been going on now for a few months. It all started what seems an eternity ago during a leadership council conference call we had with Andrew Bailey at the Bank of England. And at his encouragement, we brought together a group of senior practitioners from across financial services industries and the related professional services businesses. We were challenged to think creatively about how industry and government could work together to address the current challenge and support the recapitalisation of businesses. Now, the Recapitalisation Group developed a range of options that we believe are worthy of very close consideration for recapitalising business. And we wanted to save millions of jobs and help the Treasury save billions of pounds of taxpayers' money. We published the final report in July, and this morning we've published a data update, which Omar will address in his presentation. It's been a huge effort. It's been an unprecedented project, and of course, the circumstances are quite exceptional. We've had more than 200 people working on this, drawn very broadly from the membership. Some of them are on the call. If they're not on the call, their organizations on the call. I'd just like to say a huge thank you to all of you for participating, and especially to Omar and his team at Ernst & Young, who moved mountains and was rather short of sleep several times during the process. Now, over the next hour or so, we're going to structure the discussion as follows. First of all, Omar will kick us off in a moment by talking through the report's key conclusions and also dealing with the update. And then we'll turn to the panel, the distinguished panel, to discuss the recapitalisation in more detail and also how industry can support the recovery of SMEs right across the country. Because what we have found is that this is truly a national challenge. It's not a Southeast challenge, it's not a challenge just for the regions, but it's the whole country. So let me first just introduce the panelists. We're joined this morning by, first of all, Bim Afolami, MP, who is the Member of Parliament for Hitchin and Harpenden, which is my old constituency. I don't know if you know that, but we have that in common. And he's the chairman of the All-Party Parliamentary Group on Financial Markets and Services, and earlier had a career in financial services himself. Then Charlotte Croswell is the Chief Executive Officer of Innovate Finance and has been thinking very hard about how to raise capital for fintech and growing businesses. Omar really needs no introduction now because you've seen his name all over the press, and he's been absolutely leading from the front at EY. And then last but by no means least, of course, we have Miles, Chief Executive of TheCityUK, who has both been directing, participating, governing the process throughout. So just to remind you that you'll all be muted for the duration of the webinar, but questions can be submitted by, if you'd like to click the Q&A icon at the bottom of the screen on the Zoom interface, and then typing the question in the box, and I'll come to you in due course. So with that, let me turn it over to you, Omar.
Many thanks, Adrian, and good morning, everybody. I thought what I would do, Adrian, if it's okay, per your prompt, is I'd quickly remind everybody of the approach that we took to the programme, and then I would share the updated projections that you referenced that were released earlier this morning. There's a few slides to support that, and then I'll share some views on the reaction and the follow-ups that we've had over the summer, which I know Miles will also touch on. So as you said, Adrian, the aim of our work was to find options that support businesses return to growth, to protect jobs, ensure businesses are well placed to pay down the huge amounts of taxes that had been deferred since the onset of the pandemic, and ultimately to try and avoid the situation where lenders would have to call upon the government guarantees. Through the necessary and the various COVID-related schemes, the UK government is now the largest turnaround investor in UK SMEs. To give you an idea of the scale that we're talking about, in terms of the government's existing commitment to date, it has guaranteed well over 45 billion of lending via the schemes and deferred more than 30 billion in VAT alone. Often, the correlation between those businesses that have taken government schemes and deferred taxes is very high. So we therefore focus the work of the Recapitalisation Group on solutions for the government scheme debt, and in particular the segment of the economy which we felt had the biggest need and where new and innovative solutions would be required, not least because there is no real market for it. And that is the part of the market that is the unlisted SMEs. These businesses employ well over 16 million people across the UK and turn over more than 2 trillion. They are a hugely important part of the UK economy. So just a bit of a recap, if I may. So in May, we sized the problem based on the amount of existing lending, the stock of lending. We added to that the lending from the government schemes, and then we used our own EY Iton Club economic forecasts, which are based on Treasury's model and sectoral analysis to try and get a sense of the impact of COVID on GDP and therefore the revenue shocks on SMEs. At that point, we estimated something in the order of 100 billion of unsustainable lending by March 2021, with the government schemes accounting for roughly a third of that at 35 billion. It's important to note that those numbers, and we said it at the time, were based on very, very early take-up of the government scheme lending. And since we did the original number crunching, the outlook for the economy has improved, in large part down to the really important policy initiatives that we've seen from government in the plan for jobs that was announced in the early part of the summer. So as we committed to doing in the final report that we published in July, we have updated our figures over the last few weeks using revised scheme data, i.e. more up-to-date numbers on the uptake for government lending scheme and other economic inputs. And I'll touch on those now, if I may. So the main revisions to our numbers are driven by three main buckets. The first is a revised and improved macroeconomic outlook by Q1 2021. A second, a revised forecast for the total amount of lending to UK businesses through the government lending schemes by the end of Q1 2021. And that accounts for the recent uptake and the flow that we have seen. And importantly, we've also looked at 2 different scenarios for when the schemes may end. And I'll come back to that in a moment. And thirdly, we've managed to there's been more publication of more granular data by the British Business Bank over the last few weeks on the sectoral and regional composition of the government scheme lending. So based on all of that, we now estimate that the total unsustainable business debt expected by March 2021 to be in the region of 67 to 70 billion, which is down from around 100 billion that we predicted in May. It's important to note why that's happening. So as much as 20 to 23 billion of that reduction, of that 30 billion reduction, is coming from the government guaranteed lending schemes. On one slide. So you will see that there, the second column. So this chart just shows you how we went from the circa 100 billion of unsustainable debt down to 67, 70 billion. Just over 20 billion, as I say, comes from improvements in the macroeconomic forecast. And that is the main driver of the reduction. So we have now estimated that by Q1 2021, that the GDP figures will be 8.3% below the pre-pandemic levels as at the end of Q4 2019. That compares to our previous projection of 9.6%. So a slight improvement on where we were. And just to give you a sense of how that compares with other estimates, the OBR's central scenario is GDP being 7.1% below pre-pandemic levels by the end of Q1 2021. And the Bank of England's expectation is that it will be 4.9% worse off. So we are slightly less optimistic than the Bank of England, but broadly in the same ballpark as the OBR. So the improved macroeconomic projections also drive reduced sectoral revenue shocks relative to what we had previously estimated. And that helps account for the 21 billion of the reduction that we are looking at. we move on to the next slide, you'll see our previous estimate of government scheme lending was based on data on the volume and value of facilities that had been approved by May 2020. Our revised estimate now also takes into account data on the volume and value of government lending schemes up until 16th of August 2020. So now much more up to date. Now, what we saw over that period was a steep declines in new application volumes for both bounce back and CBILS schemes. Now, there can be lots of reasons for that, and maybe we can get into that in the Q&A. But what that does, the impact of those up-to-date figures, is that it revises our estimates down for the total amount of government lending from previously 117 billion to something in the order of 74 billion pounds in terms of what we now think will go through the government lending schemes by the time they close. And we now present the projected lending volumes as a range, reflective of two potential scenarios. I think it's important just to reflect on those. One is the scenario whereby the government schemes conclude after their initial 6-month period. And we haven't heard yet whether that will be the case or not. And secondly, a scenario whereby all government schemes are extended to the 31st of December 2020. Now, that's an important date for a variety of reasons, as we all know, but it is also the most that the schemes can be extended under the current European Commission state aid rules, and is also informed by recent extensions to business lending schemes that we've seen in other European markets, such as Germany and France, who've taken it out to the end of December. So to estimate the potential volumes of unsustainable debt then arising from these government loans, we've then applied a probability of distress, which represents for us the proportion of borrowers that may struggle to repay the government scheme loans. And a couple of things importantly to note there. The first is based on our interactions with lenders plus what we have seen from the OBR. We have increased the probability of distress for bounce back loans to between 35 and 40%, but at the same time reduced the probability of distress for CBILS to between 15 and 20% as compared to our previous analysis. So overall, I guess the conclusion, Adrian, is that this is really positive economic news. We can see that the stimulus that the government has injected into the economy is working better than we had previously anticipated in May. However, I think it is important to note that 67 to 70 billion is not a small number, and the government remains exposed to 20 to 23 billion, as you can see on this slide, of that through the loans that it has guaranteed. There is still a significant recapitalisation problem that current solutions and processes and the market just can't meet. And if we just flick on just one more slide, and I'll start to bring this to a close. Two important facets of the challenge. It is still small businesses that will bear the brunt of this challenge, and you can see that on these charts. Since the interim and the final report, we've moderately increased our probability of distress, as I said, for bounce back loans, whereas for CBILS, we've slightly reflected them down. And this reflects further discussions with the industry. And if we just flick on another slide, you'll see there remains a significant regional imbalance. Our latest updates also consider data that's been recently released by the British Business Bank, which provides further breakdown of BBLS, CBILS and syllables loans by region and by sector. You'll see a regional cut on this slide. And at a regional level, our latest estimates are broadly in line with those presented in our interim and final reports, and they indicate a broad spread of unsustainable debt in regions outside of London. London's still expected to account for around 28% of unsustainable debt, and so the regions outside of London therefore account for over 70%. And when you look at traditional options for recapitalisation, the numbers are sobering. The problems of SMEs getting access to non-bank capital is not a new problem. It's been there for a very, very long time. But we know that volumes of equity investment into UK SMEs are low. They've averaged, our analysis showed, something in the order of 6.5 billion over the last few years. And very little of this money goes into businesses outside of London and the Southeast. Now, I know Charlotte and her colleagues at Innovate Finance and also Scale Up Institute have looked at this, and I've no doubt Charlotte will share some reflections shortly. And for us, that means that there is still a significant recapitalisation problem that the current solutions and the market in of itself can't meet, and it requires some fresh thinking. So we presented, as you know, a toolbox of options in our final report. We've added some thoughts to that in the release that we put out today, and I've no doubt, Adrian, we will get an opportunity to perhaps go through them. So with that, perhaps Adrian, back to you.
Thank you very much, Omar, for running through that. A lot of food for thought there, and I think lots of extremely positive news, but also some ongoing concerns around how big the recapitalisation challenge remains for the UK, and clearly a warning that we can't be complacent about this at all. And clearly also that there remains a particular issue with SMEs, which I'm sure we will cover in the discussion with the panel now. And so with that, Adrian has already set out an introduction to the panel. I just remind everybody who has dialed in that you will be muted for the duration of this, and if you would like to send a question through, please use the Q&A function at the bottom of your screen, or feel free to email a question to me or to Adrian. If I could ask our panelists now just to come off mute. What I'll do is I'll just ask each of them a quick question, and then we will open it up to discussion and questions from those who have dialed in. And I'd just like to turn first to Bim Afolami, who is terrifically experienced in this field, and it's a particular point of pride for City UK that he was a member of our Next Generation Vision several years ago, back when he was working in the industry. So Bim, you've been doing a lot of work in this area. You've been setting forward proposals. You've been looking at what policy options might exist for Treasury and government. Could you tell us a little bit about that work and also what you're hearing both from constituents and from colleagues in Parliament on this issue?
Great, so thanks, Miles. So the work that I've been doing, and to the extent that it dovetails with this work that you and EY and Adrian and everybody has done, is about using a short-term problem of the economic problem created by COVID to also not just deal with the short-term issue, but to deal with long-term problems. And that is really around the the lack of supply of equity to large swathes of the SME sector. Now, why is that important? Because there'll be many people who say, well, we've managed so far, we've managed to write this far. Why does it matter so much? So in terms of COVID, I think Omar and all of you at the work have set out very clearly what the unsustainable debt problem is. And that's just very, very clear. And in order to deal with unsustainable debt, you've got to do two things. You've got to try and reduce that debt. And a very good way of reducing that debt is to turn some of that debt into equity, as we know. Now, the broader, longer term problem, however, is that though the government's been very good over recent years about various schemes that have been put in place, indeed the Future Fund recently, that Charlotte, would have been probably integral to putting together. In terms of growth industries, growth businesses, we're very, very good actually at providing equity to those. What we're not so good at is providing equity to the large swathe of SMEs that are not high growth, they're not in particularly sexy industries, and they're not the sort of things that's going to make a VC fund a lot of money, but they're very important to the economy, they're very important to local areas, they're very important to jobs, and so we need to make sure we support those as well. So my work's been on focusing almost on those. I think that frankly in Britain, not just in this issue, but in all sorts of others, we're very, very good at dealing with the top 10%. And it's about everybody else that I think is really important. From a political perspective, it's very obvious why that is also important, but it's also important economically. In relation to the point around where are we and what are people saying and what's Treasury saying, I think it's fair to say, and I've got Treasury questions after this, I think it's fair to say that government is keen on facilitating those people in the industry to come up with different ways of doing things. The government is not averse to getting involved. As I say, the Future Fund being a very good example where the government has got involved and also private sector has done a huge amount of work around that. But they do want that sort of leadership from the private sector as well. And I think that finding models where that can happen is very important. I look at an issue like, for example, infrastructure financing, which, you know, in the real world is just not going to happen just with government. You're going to have to find private sector capital. That's where people are. So I think that the door is definitely open. For anybody listening to this, I think the government is frankly more involved in the British economy than it has been for 40, 45 years. So the government really matters. But at the same time, I think they are very cognizant of the need to make sure the private sector leads solutions. And so what I'm trying to do is to try and knit those things together.
Bim, thanks very much for that. We've just got Adrian back. So Adrian, is your microphone working?
Well, let's hope it is. Can you hear me properly now, Miles? Is that better?
Brilliant.
Brilliant.
Yeah.
Okay. Thank you very much for that, Bim. That was tremendous. Let's move on to Charlotte. As Miles and Bim were saying, Charlotte, you've been very focused on trying to work out what support can be needed to help scale-ups grow, the growing businesses grow. Can you just tell us a little bit more about the work you've been doing?
Thanks, Adrian, and thanks for having me today. And we've been looking at this in two different ways. The day job, looking after fintechs, we've been looking at SME lending, and therefore I've been deeply involved in Sybil's from the start. So I'm coming up to my 6-month anniversary, like most, next week. And looking at what may happen at the end of Sybil's, if that is at the end of this month or the end of December. But actually, in association with the Recap Group, we looked at this from a slightly different angle, because obviously the knock-on impact of bad debt is going to potentially hinder economic recovery. And when we started looking into equity type instruments, we felt that there was a coordination approach needed to look, to Bim's point, of also where's our growth capital gap and how do we use equity type instruments instead of debt as well. So we did a little bit of work for Recap Group. We couldn't make Omar's very aggressive timeframes to finish that. So actually what we did is we published it towards the end of July on something called the Growth Capital Report. We looked at this, we said, where is the equity missing? Where has it been fed from? What are the cyclical gaps coming out of COVID, but also what are the structural gaps we've had as well in terms of equity, and how do we address this? And it was interesting, with the Future Fund, looking at the appetite for that and why it was so popular, and and looking at that as a base, is there something we can do to direct some of that success into maybe more targeted areas? Because to our point, a lot of people criticised Future Fund and said it's all going to go to London-based companies. It's going to be swamped by VCs who've got their applications lined up by midnight, and they did, ready to take advantage, and everyone else would be shut out. And in fact, what we saw through that, through the Future Fund applications, was actually quite a good regional divide. We did, Treasury and the British Business Bank were capturing, diverse founders, and really focusing on some of the things that we wanted to fix. We couldn't fix everything during a crisis, but capturing that data and looking at the appetite gives us a chance to then build on what comes next. Now, we again, came up with some very big numbers. We estimate the structural gap is around 5 to 10 billion per annum anyway in growth capital, coming back to Bim's point, and some of those businesses that just don't have access to equity or wouldn't even think about equity in the UK. And then we looked at the risk of a cyclical gap, potentially adding up to 7.5 billion per annum. Potentially looking at the impact spread across those regions and looking at the sectors that can potentially attract that growth capital. An awful lot of analysis and some great support from people like Silicon Valley Bank and BlackRock, who are giving us that data versus the US, and really saying, if we were able to have this growth capital, what role does that play in economic recovery? And it becomes the same issue. It's not just about, we can't just look at recapitalization of bad debt in isolation. We've also got to look at where there are opportunities to work together. I know full well, post-2008, that SME lending declined at the banks because they didn't want to put SME loans out. That's why we saw a fairly healthy move over to the non-bank lending sector, which we have in place now. If that declines further as a result of risk of bad loans then we have a real risk that obviously the banks reduce that further, putting pressure onto the non-bank lending sector. So I feel that, it is that sort of saying, we are on all this together. I think the advantage we now have is we have the best in class, people around the table from industry. We have regulators involved. We have government involved. We have technology solutions that potentially can be used to look at this. And also, I think there is a real desire as part of the levelling up agenda to look at this, not just London and not London, but actually, how do we split out different types of sectors, impact investing, our build back better into green, and looking at those as we build back that recovery and saying, right, how do we direct these efforts to ensure that as we come out of this crisis, we're using the best in class people, technology and impetus to make this happen. So it's delighted to sort of look at this together with this group, and really looking at our opportunity to use lending, to use equity, and really use industry to advise government on saying how do we build back better, more greener, with better impact investing, and across the UK, not just in certain areas.
That's super, Charlotte. Omar, let me come to you and pick up a few strands in both those answers. I think that one of the concerns we had in the recapitalisation group is that we're worried that this problem might start spinning out of control a bit, because we've got the bounce back loans and the surplus loans starting due for repayment next year. We've got tax deferrals. We've got possibility of rent relief coming to the end. We've got the furlough tapering off, so that it's a critical juncture. Now, when you look at our proposals, or broadening out the proposals, picking up some of the themes that Charlotte and Bim were referring, how quickly do you think we could get something on foot if the government decided to proceed?
Thanks, Adrian, and thank you to Charlotte and Bim as well for all of their support for the work that we've been doing. Just, I guess I would distinguish, Adrian, if I may, between growth capital, as Charlotte has been talking about, and Bim referenced the Future Fund, and the distressed capital, which is what the essence of the recap work then became. I think history would show that the creation of something like the Future Fund can be done in a matter of weeks. And I know that some of the work that came out of Charlotte and the Scale Up Institute's work suggests that funds could be put together in very short order to deal with allowing some of our companies that are looking to grow, providing them with access. I see no reason why that can't be done very quickly. And indeed, there's lots of recent precedents. On the distress capital piece, Adrian, as you know, we spent a lot of time working through a whole heap of complexities. So there's complexity number one, which is there is no ready-made market for small SMEs to access equity. Most of the way they get access to finance is through branch-based or bank-based lending. Equity is not really a thing. So there was an issue number one. Issue number two was when you then project the volumes of companies that may need help, there just was not enough capacity in the market to deal with it. So yes, there are some firms out there, and some may well be on this call, who do provide distress equity for SMEs. But to give you a sense of it, last year our estimates suggest that was probably in the tune of £1 billion. And when we are talking in over 20 to 23 relating just to the government lending schemes, and 60 to 70 overall. And part of the challenge is, of course, one of timing. So this is about how do you create the capacity such that it can be put online in very short order, because the risk was, and as we outlined in our final report, that it is this quarter where we will start to see large volumes of SMEs coming into trouble, particularly as we come to the end of furlough. And then at the beginning of 2021, many of these companies will have to start repaying back the taxes they have deferred. So in order to deal with both of those challenges, market distortions, market failures, we came up with some ideas that allowed companies the ability to trade back better, to rebuild themselves. And of course, some of these, which we outlined in the final report, included things like what we call the business recovery capital or business repayment plan, both of which had similar underlying criteria, i.e. they could be deployed at scale, they would be simple, they would be transparent, they would be easily understood by end businesses, easily understood by the lenders, but provide businesses with the opportunity to start repaying government scheme debt as they started to become healthier. And we still believe that is a sensible way forward to come out of this issue. Equally, we have put forward in today's update a further option for Treasury and others to consider, and that is to essentially buy businesses time. So we've suggested that there could be additional forbearance. So the repayments, instead of starting a year from the moment that the loan was crystallized, could be pushed out another year. That would require the government and Treasury to believe by doing that, that would offset or reduce proportionately the probability of default or probability of distress in these businesses. And if the government were able to deal with the interest that is due to the lenders for that period, then there is an opportunity to perhaps do something that wouldn't be as dramatic as some of the other proposals that we put forward, but could have a benefit to begin with.
Super, Omar. Thank you very much indeed. That's tremendous. Now, Miles, we have been, the group responsible for this project has been in touch with regulators, with government, with trade associations. Would you just like to reflect a moment or two on how we have built a base of support for this?
Sure, thanks for that, Adrian. I'd just like to thank everybody who's been involved in this work, both on the panel and indeed on within the wider membership. In terms of how we've engaged with government, how we've built this this bedrock of support for the activities, I think it's worth bearing in mind that the original impetus for this came from a question put by Andrew Bailey, as we touched upon earlier, to the Leadership Council of the City UK about how the recapitalisation challenge for all these SMEs is met, and the bank has been closely involved in this work since its genesis. And we've been engaged with Treasury officials at working level and senior level again throughout this entire process, as well as officials from the FCA, BEIS, and elsewhere. So there's been a very good, very constructive, very fruitful discussion with all of those bodies throughout this entire process, and we've been keen to ensure that that's been the case. And then looking at industry, I think there are two things I draw upon. Firstly, our own industry, and secondly, the wider economy. And I have to say, it's been genuinely inspiring, verging on awe-inducing, the extent to which this industry put its shoulder to the wheel on this. The amount of time, the enthusiasm, the commitment, and it was genuinely done. And Adrian, you were a terrific part of this, as was Omar. It was genuinely done in a sense of a pro bono, a genuine pro bono public good. That this was an instance where the industry could play its part in supporting small businesses, in supporting communities, in getting ready to drive the recovery from the virus. So the industry, I think, came together extremely strongly, and you can see that, as has been touched upon, in the number of people who very generously gave enormous amounts of time and resource into it, and the number of organisations that did the same. And then I think a critical part here is thinking about the end user. So this wasn't done in isolation. This was done in close collaboration. This work was carried out in close collaboration with those who ultimately will be the beneficiaries of the work, and those who are at the greatest risk of their businesses going under, and those are the SMEs. And we worked extremely closely with the major business groups outside our industry. Particularly want to thank organisations such as the Federation of Small Businesses, the British Chambers of Commerce, the CBI, and others. And those were chaired within a particular group by Bob Wigley of UK Finance, who did terrific work. in ensuring that there was a strong dialogue between the work and those who ultimately would be the recipients of any benefits that came from it. And then what we've done since then is engage proactively across the UK, not just in Westminster and Whitehall, with political leaders, public policy audiences, metro mayors, the devolved assemblies, as well as I say, within the capital. And there it's been an ongoing positive dialogue, not always a dialogue where we will entirely agree, I'm thinking here of Treasury with the analysis and the solution, but it is an issue with which Treasury is grappling and will continue to grapple, and with which they are keen to maintain a positive dialogue with us, and that's something we'll continue to do, including utilising this work to maintain the currency and the usefulness of what we're doing.
That's super, Miles. Thank you very much. Shall we now turn to the questions that have started to come in from the people on the phones here? First one is from Rolf Lakin at the Bank of Australia, National Australia Bank. And he wants to probe a little bit more on the regional impact. I mean, he's got a question here regarding Wales. I mean, Wales is 2 to 3% of sustainable debt. Is that 10% of Welsh SMEs? How should we reflect on those numbers? I think probably Omar, it's for you to start, and then perhaps I'll turn to Bim for a comment as to how these things are appearing in his discussions with other MPs. So would you like to start, Omar?
Hi, Rolf. Thanks for the question. Nice to hear from you. I think that's a fair assessment of the data. So I'm just looking at the slide. We had previously estimated that 3%. We previously estimated, 2% of the total unsustainable debt would be out of Wales. We're now suggesting that's up to 3%. How to interpret it? Yes, that probably feels like it's about 10% of the total number of SMEs in Wales. We know in the discussions that we've been having with the devolved administrations and including Scotland were estimating that their impact would be 6 to 8%. I think Northern Ireland similarly. So you won't be far off, Rolf, thinking in that sort of ballpark. I think the important part to note on this is that there's a few things, and this isn't our analysis, but number one is that when people return to work, the vast proportion, something over 90%, return through an SME. And when you look at what that means in terms of the impact on, we saw the unemployment data out this morning, particularly on those areas outside of London, the importance of keeping these businesses able to trade, it should not be lost on us. And the other part I think that is important is the concentration of smaller companies in areas outside of London is higher as a proportion than the bigger companies. And therefore we are seeing, and our analysis shows this, particularly in the numbers of companies potentially impacted, which we estimate to be in the order of 1.5 million, 70% of those are outside of London. So if we can't find a solution to this, it is clear to everybody involved with the recap work that there will be a disproportionate impact on areas outside of London, and I guess areas that can probably least afford job losses and business failures.
So Bim, if we work on that theme with you for a minute, I mean, the bounce back loans are going to the smallest businesses in the country. The high street businesses, the family-owned firms. And these are people who often have day-to-day contacts with MPs. I always wonder whether you're starting to get any feedback from them or whether you're picking up among your fellow MPs the feeling that it's starting to rise up the agenda as an issue this?
I think the problem with politics is that people always deal with things that are right in front of them. Yeah. And then they wonder why that big thing is right in front of them. The answer is, well, if you'd thought a little bit harder, you'd have seen it as it was coming. This is a perfectly good example of that. So constituents who, and in my constituency, and you know it as you mentioned, there are a lot of business owners, a lot of small business owners, and their focus has been on keeping themselves afloat. A few of them have sort of said, well, you know, I'm not sure I'm going to be able to pay this back, but I spoke to my friend and my friend just thought, well, that'll be the case for so many people, the government will probably cancel it, so don't worry. And there is that assumption out there amongst a lot of business owners, which I think people have to be very mindful of. In terms of my colleagues, I'd say there is a small number of people who are very sort of, who worked in the industry, who speak to people who understand this to be an issue. I don't think it's something that's permeated beyond that group. However, these things, when they come up, come very, very quickly. And what people will start saying is, why are all these businesses going bust? So I think that the job of really being effective in this area is to, first of all, make more people aware that this problem is coming, but make them aware and present them with potential ways out of the difficulty, which is what you've done. I personally think that the communications and the discussions that need to be had with a broader swathe of MPs and particularly the Welsh and Scottish secretaries who I've spoken to, and I'm sure I know you guys have dealt with all the devolved assemblies, but I do think it's really socializing to them that they could have a really big problem here. I know that, for example, the local enterprise partnerships know that this is a problem, but I'm not quite sure how that is linked up with my colleagues. I don't think it has sufficiently. So going forward from here, one of the things that I will do, and I'll speak to you about it, you know, and you and the team, is to really, really socialize this problem with local MPs.
Yes, that's super, Ben. Thank you very much. Next question comes from Kay Swinburne from KPMG. Morning, Kay. And I think that it's an interesting question because it probes the attitudes of the devolved administrations, the Welsh and the Scottish governments in particular. And she points out that these two governments already have entities. In Wales, the Development Bank of Wales, and in Scotland, the Scottish National Investment Bank. And both of them can use debt and equity for SMEs. Do we know how they've been performing during the crisis? Do we know what sort of instructions they've been given from the devolved administrations? And of course, there's lots of talk now about a national investment bank for the UK as a whole, or at least for England, I suppose. So Miles, would you like just to talk a little bit about contacts with the devolved administrations and, if you can, about the performance of the development banks there?
Sure, thanks very much, Adrian. So I can't comment in detail on how the Development Bank of Wales or the Scottish National Investment Bank have operated. But what I can say is that we've had very close conversations with both the Welsh and the Scottish governments, and indeed with the Northern Ireland executive as well. And we've done that partly through our network of city chairs, but also in Scotland working very closely with Scottish Financial Enterprise. And in Scotland, we've briefed, me together with you, Adrian, and with Omar, have briefed the Financial Services Board that the Scottish Government has, which is chaired by Nicola Sturgeon. And indeed, Nicola Sturgeon has been very closely interested in this work and has asked to be kept updated on the work. And we've spoken to Ian Blackford in Westminster, together with other key SNP and Scottish Government figures. And I think what's come from that conversation, as well as the conversations that we've had in Wales and in Northern Ireland, is a recognition that, firstly, this needs to be addressed. So there is a strong feeling that this is a problem that is coming down the track, to Bim's point. Secondly, that it requires a national scheme. I think there's an absolute recognition that this has to be a national scheme, but that needs to be implemented as close as possible to the end customer, to the end user, to the SMEs themselves. So that's been almost universal in terms of the reaction. And we've seen that in the English regions as well. So we've been cooperating, for instance, with the Northern Powerhouse Partnership and others. So a strong recognition that this needs to be done very, very close to the end user. So that is an ongoing engagement that we're having. I think the other element that drops out of this, which we've talked about before and has been an element of our proposals, as in many ways as a question or a thought rather than a central set of recommendations, is what's the legacy here? And this, I think, absolutely touches upon the point that Kay has raised, but what is it that government needs to do, and we've touched upon this in this discussion already, or could do to make best use of this crisis, to ensure that we look at some of the challenges that we've historically had in the UK in terms of investing in companies for the future. Something that 3i used to do, something there have been other attempts to do in the past, but does this look like a set of regional development banks? Does this look like a national infrastructure bank? What is the form of this? And I think what we've always said is that is a question for others to take forward. We've got thoughts on it, but we need to make sure that the proposals that we've set forward could potentially offer a framework or a foundation upon which a successor organisation could be built.
That's super, Miles. Thank you. Now, the next question comes from Tim Creed at Schroders, and he says that the unsustainable lending burden has been discussed, as has, open quotes, the need for equity, close quotes. In our view, in the view of the panel, what changes are needed really to get more equity in the system? Would you like to have a first crack at that, Charlotte?
Yeah, sure. Thank you. Certainly, when we were looking at the equity capital gap, we did a lot of work around regional investment, whether that is Scotland, Wales, Northern Ireland, but importantly England. I know it's a frustration of many mayors that a lot of the English funding is decided from London. And some of the recommendations we therefore looked at was how do we expand and build upon the British Business Bank, maybe moving some of that into local decision making. I think gone are the days where you need a regional office, because we're all often, I'm in the office but no one else is. So we can certainly make that there, but really having that empowerment locally and building that up within the ecosystems. All of these regions have amazing ecosystems, but how do we get that education and knowledge of what equity is if people don't understand it? And we do a lot of work, as does Miles, around the UK, and it's a huge difference in education and knowledge. And same, how to pay back this debt as well, which we should touch on. And then looking at that of how do we develop those products with the Scottish National Investment Bank, with the Development Bank of Wales, and with Invest NI, as I said, and looking at how we take this outside and around the UK. I think there is opportunities for those in innovation for us to expand the role of Innovate UK, and obviously there were some loans put out there, and really looking at that, what I call sort of national blueprint. So we're, a lot of the time, we've added things in and added things in and added things in, over the last 20 years as everyone's been trying to crack this nut of equity. But I think it is time to take that step back, with this government, and say, how do we actually take that step back and look at this as a national approach? And how do we get the decision making into the right people, into the right regions, and where there are opportunities for equity, let's make sure people really understand the advantages that has and how to go about getting it.
Bim, let me come to you next, because clearly the government wants the private sector to assume as big a burden as it can in this recapitalisation process. And I know you've had thoughts yourselves on how a new effort at recapitalisation might be structured. Would you like to address this point?
Yes, I mean, I agree with much what Charlotte said. In terms of how I think you could structure it, quite simply, what you would do is you would get a big pool of capital, of which the government would need to be one of the main sort of anchor investors, if you like. That could then be a source of helping to corral private finance to join that big pool of capital. And then working with everybody from Schroders, the British Business Bank, British Growth Fund, whoever, feed that capital through different investors, fund managers all across the country who have understanding of the businesses. However, what I also think is important is we can often make things very complicated and interesting, and that's important because sometimes you do need to set up big new things. It's always good to look at tax or regulatory changes that can make what people do today a little bit, make them do it a lot, and therefore increase the amount of fundamentally in the system, going to Tim's point. So I throw a question out to Tim, which is obviously what I do when I don't know the answer, is how, from Schroders' perspective, for example, and is there a tax change that you would look at and say, you know what, if you did that, I could raise more money for my investors to invest in British companies, unlisted companies. Is there anything that comes to mind that's obvious, or is it just a broader question about the environment and so forth?
That's super. Miles,
oh no, he's not. He's on mute, so he can't reply.
No, he can't reply. But I think it's a sort of answers on a postcard, please.
Yeah. Well, anybody send on Q&A because ultimately, if we can find clever ways of incentivizing people to do this, then this could also really benefit.
Absolutely. I mean,
Adrian,
in the report, Omar, we spent quite a lot of time discussing appetite and risk and return considerations across a broad range of investors. And I think although we need a more strategic approach to the deployment of funds, we've got to create the conditions in which the investment community as a whole is prepared to back SMEs. And you might just spend a moment or two reflecting on the process and the difficulties.
Yeah, I mean, that's exactly right, Adrian. And we interviewed over 30 investors who operate in this space. And of course, Schroders were heavily involved also. I guess the good news was that there is a large amount of private capital theoretically available to be deployed into this space. And I guess that's why BIM and colleagues will be saying, well, why can't we just find a private sector solution to this? So we went and analysed, and this is all in the final report, as you say, capital that's held out by insurers, both on and then pension funds on the DB and the DC side. We looked at sovereign wealth funds, we looked at private equity, venture capital, private debt funds, and retail investors. And we analysed what would it take to get these investor types into providing SME distressed equity. And there are a whole bunch of challenges to doing this. They're not insurmountable, but they are definitely difficult in short order. And they include things like the risk reward dynamics that some of these investors will want. Some of the investors that I've talked about in some of those classes will want returns of between 15 and 25%. Do we think that is a sensible thing to be asking for, particularly at the micro end of the SME pool? There are other investors who want to see return history. And of course, there is precedent for this. Indeed, the Student Loans Corporation have managed to, over the last few years, securitize a lot of their receivables and get them away. We saw the same with NAMA in Ireland. And of course, we've seen the same here with the Bradford and Bingley, Alliance and Leicester and other mortgage books that the UK government took on. After there is some understanding or some history of the returns that are being put out there, the private sector, I think, would be very willing to come in. We then looked very hard at insurance money, and to BIM's ask, there are some regulatory challenges, not least what has come out of Solvency II, that makes it slightly more difficult for those types of investors to come in. And who knows, in a post-Brexit world, we may well be able to look at some of those things again. But I guess, BIM, the challenge in trying to unlock all of this was trying to do it in a short order that would allow these types of businesses to put equity in at scale.
Super. I think we've got time for one more question. And this is the $64,000 question, which comes from Stuart Johnson at NatWest. He asks, should we be concerned by the Chancellor's response or the Treasury's response to the proposals? So we don't think we've had a formal response yet. We're interpreting the smoke signals in the FT. And if so, how do we move this topic forward in the absence of HMT support? It's a good direct question, Stuart. I can't think of anyone better to answer it than you, Miles. Miles.
Thank you very much for that, Adrian. So should we be concerned? Yes, of course we should be concerned. It's important that Treasury is on board with these proposals, and we are continuing to engage with them on that in a constructive way. I think what I would say is, firstly, I think we're still relatively early in Treasury's thinking about this. So there is an ongoing process. I think there's been a genuine challenge of bandwidth at the Treasury end. I think there is also quite clearly, on the other hand, a groundswell of opinion outside Treasury that this is an issue and that it needs to be addressed. And I would point to the Treasury Select Committee report as just one example, the Treasury Select Committee report last week on the economic consequences of the crisis, which specifically tasks Treasury with looking at this problem, using the TheCityUK Recapitalisation report as a starting point and coming back in 3 months' time with solutions around what it's going to do in this space. So I think it's important to look at this as an ongoing process, a discussion, a process of constructive engagement around policy. We all ultimately want the same thing, which is the best possible economic recovery and the greatest number of SMEs to survive and to be able to thrive, not to survive after this. And we'll continue to work with Treasury to achieve that.
Thank you very much, Miles. I absolutely second that. I mean, this is the start of the process. We expect this dialogue to continue, not just with Treasury, but right across the government. And I think we're just about out of time, Bim, so I think we're probably going to have to wind up proceedings now, since we've got a hard stop of 11:30 and it's 11:29. So I'd just like to thank all the panelists for their contributions today. I think you all got slightly different perspectives, and I think we've been able to give the audience a rich vein of commentary and opinion. Thank you all in the audience for the time you've taken to join us today and your questions. And, you know, as Miles has said, we're continuing to engage with a broad range of stakeholders, both in government and outside government. This is a problem we all know exists. The Treasury, I think, is quite frank in admitting that there is a problem, especially with bounce back loans. And we want to preserve these businesses. We want to allow them to thrive as best they can, and we will continue to work in that vein. And we'll have much more discussions like this, I think, as the weeks go by. So thank you all very much for attending. And with that, good morning. Thank you.